Welcome to this explainer. Today, we're putting on our skeptical equity research analyst hats to perform a hardcore, data-driven financial autopsy of Ameren Corporation. We're not here for the flashy stock charts or the talking heads, you know? We're operating as investigative journalists, drawing strictly from their 2025 and 2026 filings to find the actual truth. We are skipping the media hype entirely and diving straight into the 10K and 10Q line items. We want to see exactly what's happening right beneath the surface of this utility giant. We're pulling out the raw data to figure out if the underlying fundamentals actually justify the mainstream narrative. Now, before we run the valuation gauntlet, I want you to consider this single number, $31.8 billion. That is Ameren's massive infrastructure capital plan, which is meant to capitalize on grid growth and the whole AI data center boom happening through 2030. Honestly, that's a staggering amount of capital expenditure, and it completely rewrites how we have to model this company's future cash flows and their debt liabilities. Disclaimer: this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. All right, let's initiate the ultimate valuation gauntlet, starting off with the cash flow models. Right off the bat, Ameren's massive $31.8 billion capex plan really depresses these numbers. If we run a standard discounted cash flow model, projecting their future cash and discounting it back using their strong $991 million operating income, we get an intrinsic value of $78 to $85. Unlevered free cash flow, which strips out their $413 million in interest charges to see the raw business cash, bumps that up slightly to $82 to $88. But here is the anchor, right? When we look at free cash flow to the firm to account for that massive capex drag on the entire enterprise, the value drops heavily to $65 to $72. And free cash flow to equity, measuring what is actually left for the shareholders after servicing that $19 billion debt burden, that yields an even lower $60 to $68 per share.
But pivot over to the dividend and income models, and the picture changes entirely. You see, these models absolutely love Ameren's secure 51% payout ratio and their solid $3 annualized dividend. The Gordon growth model, which values a stock by assuming dividends grow at a constant rate forever, in this case their historical 6.71%, kicks out a much higher intrinsic value of $90 to $95. Even the residual income model, anchored by their climbing $49.45 book value to measure excess returns over their cost of capital, points to a really healthy $85 to $90. This perfectly illustrates the classic tug-of-war in utility valuation. The cash flow models absolutely hate the heavy investments, but the income models just love those reliable, regulated dividends.
Next up, we're going to stress test their market multiples. Their trailing 2025 earnings per share of $5.35 is our main anchor here. A standard sector price-to-earnings multiple yields an intrinsic value around $85 to $90. But check this out. The precedent transaction analysis, which looks at historical acquisition premiums if a larger player bought them out lock, stock, and barrel, suggests a takeover value closer to the $90 to $98 range. So what's the catch? Well, their enterprise value to EBITDA multiple, which looks at the total value of the company, including its debt, is weighed down heavily by that huge debt load we just talked about. Let's pivot strictly to the hard assets. The absolute floor here is their stated book value of $49.45 per share, but the replacement cost model is what's really fascinating here. Ameren sits on $41.3 billion in net property, plant, and equipment. I mean, good luck trying to rebuild those power grids, regulatory moats, and energy centers from scratch today. Factoring in inflation and supply chain realities, the replacement cost value easily blasts past $110 to $130 per share. Now, standard models often completely miss asymmetric upside, and that's exactly where real options valuation comes in. Ameren has secured massive hyperscale data center pipelines, like their 500-megawatt Google deal. If we apply standard Black-Scholes logic to treat these future expansion projects essentially as financial call options, it adds a theoretical $5 to $12 premium per share right on top of our base case valuations. Now, if you tune into the standard financial media, they love to soundbite simple metrics, like the Q2 2026 EPS jumping 12% to $1.13. But as objective analysts, we are completely ignoring those simple revenue beats and earnings headline numbers. We need to actually dig into the footnotes to see what's driving the machine. It's time for the forensic audit. We are going to expose 14 hidden accounting flags buried deep in the operations and maintenance expenses and the regulatory filings. 7 red and 7 green, that the media completely ignores because, well, they just don't fit into a tidy 10-second television segment.
Let's start with the 7 deep red flags the media glosses over. What shocked me first was seeing O&M expenses rising past $1 billion in just 6 months, largely from granular things like tree trimming, which is simply too boring for a quick headline. Second, unpredictable mild weather caused retail drops, and unpredictable variables tend to scare off simple analysis. Third, their $19.06 billion long-term debt is scaling rapidly, putting a massive dent in that safe utility narrative. Fourth, surging interest charges hit $413 million. It's boring accounting, but it eats real cash flow. Fifth, watch out for negative off-system sales that popped up in late 25, buried way down in the segment data. Sixth, employee headcount actually shrank to 8,940, completely contradicting their massive expansion narrative. And finally, their severe reliance on Missouri and Illinois regulatory approvals involves far too much jargon for standard TV coverage to care about.
Juxtaposed against those risks are 7 overlooked green flags. 1, they have a 10.6% rate-based compound growth rate locked in, but you really have to model out to 2030 to fully appreciate it. 2, a steadily climbing book value of $49.45, which is completely ignored by folks chasing flashy PE ratios. 3, that massive 500-megawatt Google hyperscale deal. It's only visible if you track primary service customer filings. 4, their highly safe 51% dividend payout ratio lacks the drama of a high-yield trap, so it just gets ignored. 5, they utilized strategic tax benefit shields in late 25. Deferred taxes put casual analysts to sleep, but they save real capital. 6, parent company tech losses narrowed to $18 million, which requires reading across multiple business segments to even spot. And 7, a 6.71% 5-year dividend growth rate. Absolute proof of slow, steady compounding that simply doesn't drive clicks.
So what does this all actually add up to? Let's put this stock through the legendary investor's reality check, starting with Benjamin Graham. If we calculate the Graham number, taking the square root of 22.5 multiplied by their $5.35 EPS and their $49.45 book value, we get a strict, fundamentally defensive baseline of $77.14 per share. Why does this matter? Well, because it acts as a profound margin of safety anchor. It lets us know the absolute lowest fundamental floor before we even consider future growth.
Next up, we run the numbers through Peter Lynch's framework. Now, Lynch loved combining yield with growth. If we take Ameren's 7% midpoint future growth guidance and add their roughly 2.75% dividend yield, we get a total return expectation approaching 10%. However, their PE ratio is floating near 16 to 20, depending on trailing versus forward earnings. Dividing a high PE by a 7% growth rate gives a PEG ratio well over 2.0. So for Lynch, who typically wanted a PEG of exactly 1.0, this stock might actually look a little bit expensive for pure growth at a reasonable price investing.
Finally, let's look at Warren Buffett's strict criteria. We had just reported net income from maintenance capital expenditures to uncover true owner's earnings. Basically, the actual cash you could physically pull out of the business without hurting operations. Here, Ameren kind of struggles. Their $19 billion debt load sits really heavy against their EBITDA, pushing their net debt to EBITDA multiple well over 5 times, which is a threshold that typically makes Buffett pretty cautious. However, as we're about to see, Buffett would absolutely love their monopoly structure.
Synthesizing all of our quantitative data into a final verdict. Based on the average of all 21 models run in our valuation gauntlet, Ameren is currently calculating as fairly valued to slightly undervalued. The dichotomy here is wild, you guys. The cash flow models are deeply penalized by their massive capex and debt loads, which drags the average way down, while the dividend, asset replacement, and real options models are screaming massive premium value. The deciding factor, the absolute trump card here, is the moat. Ameren possesses a wide economic moat built firmly on efficient scale. In their designated territories across Missouri and Illinois, they are the effective monopoly. Competitive entry is virtually impossible because rebuilding a $41 billion physical grid is just financially irrational for any newcomer. And with $31.8 billion in new infrastructure spending planned to capture AI data center demand, this incredibly powerful moat is actually expanding aggressively over the next 3 years. So here is our clear, nuanced takeaway. The dividend growth and expanding rate-based models look highly favorable, painting the picture of an unstoppable, regulated compounder. But the escalating $19 billion debt, the surging interest costs, and that heavy reliance on state regulatory approvals present real friction that could compress those future earnings. The models are pointing one way,
but the hidden debt flags suggest a potential storm. Which side of the trade are you taking? Do your own homework.